Well, tomorrow, the Federal Reserve will announce its November interest rate decision. Now, markets are largely predicting officials will keep rates unchanged yet again, but much less certain is the Fed's future policy. And the data-dependent Fed has much more to consider than just inflation. Escalating geopolitical tensions and a looming government shutdown all place additional pressure on officials navigating an already complex economic environment. Joining us now is Cindy Beaulieu, Conning Chief Investment Officer for North America. Thank you for joining us this morning. So obviously, we're largely expecting the Fed to keep rates unchanged. What are some of the commentary that you're going to be honing in on when we hear from Fed Chair Jay Powell?
Sure. Thank you, Rochelle. Great to be here. So tomorrow, yes, we agree that the call is going to be unchanged from the Fed's perspective. And for the reasons you mentioned, a lot of uncertainty in the world still. Hard to believe 3 years post-COVID, there's still uncertainty, but we seem to keep finding new ways to bring it forward and create more volatility. What we're really watching for is how concerned they continue to be about inflation. Core PCE at 3.7% is certainly encouraging and it's moving in the right direction, but the easy work on inflation is done. And there is some persistency to the inflation that we're seeing today. And given the type of print we just saw with GDP in the third quarter, it's likely that this next move lower to get to their 2% target is going to be harder and take more time. So the vigilance around inflation is something that we want to hear from him as to whether or not he will be as strong and hawkish on that as he has been in the past. And then what are they seeing on the labor market, which we think is also a good reason why they should pause tomorrow as well. We got a very big print for September non-farm payrolls. We expect that gets revised away. And the Fed is likely going to try to look through to gather more data and maybe at the December meeting have enough. But right now we want to hear what they're thinking about the labor market and how concerning is it that it's still relatively tight for their liking.
Yeah, Cindy, to your point, we have seen recent economic data point to inflation continuing to be sticky, but we've also seen the rates on bond yields certainly push higher. I mean, marching towards that 5% on the longer end, we've seen it at 5%. How does that complicate the calculation for the Fed, you think?
So it's interesting, we've heard a number of Fed governors talk about how that actually may make their job a little easier, that if rates can stay at these higher levels, it does the Fed's job for them. We've seen the 10-year test 5% several times, and it has not been successful in sustaining that level, which maybe tells you a little bit about all of the uncertainty that's out there and the different factors that are coming into play as rates are rising. But the fact that we are seeing rates rise does ultimately make it easier for the Fed to be less vigilant with their rate increases and allow the markets to do a little bit of work for them. But they need to see that sustained, and we're not getting that right now. We do believe a lot of the pressure that's happening in the bond market is also reflecting the fiscal side of the situation, which is not good. We do have a large deficit that did increase again. We obviously have a lot of Treasury issuance at a time when you have to question who's supporting that. And that is definitely factoring into pushing rates higher, particularly on the longer end of the curve.
And so in expectations for December, if we do get that rate hike, is this going to be a slow and steady push here? We know that obviously Chair Powell has said, look, they want to nip it in the bud. They don't want to sort of go easy on inflation and then have to revisit and upset things all over again. How aggressive should the Fed be then in December?
We believe it would be just another 25 basis point increase if the data supports that when we get to that point in time. And then they can really fully go on this hold that we do expect. We've been a subscriber of rates higher for longer through this whole cycle. We see the reason for it, given just the stickiness, stubbornness of inflation and the various sources of it. So I think, for the December meeting, 25 makes sense, and then the hold. There are some factors that the Fed has to be monitoring very carefully beyond those they're already dealing with today. Certainly, as I mentioned, the fiscal situation, if we do ultimately get to a budget agreement, that could prove to add to inflation again if there's excessive amounts of spending that are built into that budget plan. And the other side of it is the geopolitical conflicts. Wars are by their nature inflationary. They can, kind of bring inflation in from a couple of different sources. Oil is a little bit different this time from prior cycles because there are alternatives to it in terms of where it can be sourced from, but it doesn't change the fact that we still rely very heavily today on Middle Eastern oil. And so the fact that we're looking at possible escalation of a conflict in that region of the world is a bit problematic. Another reason why the Fed holds now, but maybe by the time we get to December, they have a little bit more clarity there and can use that as they think about their next rate decision.
Cindy, this is a Fed that is still divided, though. We've heard some more dovish members of the FOMC, those like Austin Goolsbee as well as Raphael Bostic, really warn about the lag factors from the Fed policy. You're calling for another 25-point basis hike. Is the economy strong enough to support that when you factor in that the full effect of these hikes we've already gotten hasn't taken effect yet?
I think that that's very true in terms of the lags with which monetary policy does have an impact. And the lags this time are a little bit longer. And that really comes from the fact that we've had an unbelievable amount of liquidity built into the system, way more than it needed. You think back to the period before COVID when we had such low rates for such a long period of time. And that's allowed so many homeowners in the US to have mortgage rates that are just really attractive for them to hold on to and no reason to move. Then you had 3 different stimulus packages that allowed for a lot of consumers to be very comfortable in their homes. But today, at the end of the day, we're looking at a country where more than 50% of the people have less than $1,000 in the bank right now, and that's concerning as well. So I think the Fed, part of the reason why they've been careful in their pauses along the way here has been because we have seen so many lag effects in this that have taken place, and that's why they're being cautious and careful. But I think the problem they have now is that their 2% target is not in reach. 3.7 is great, but it's still not 2. And it's looking like even by their own forecasts that they won't achieve 2% even by this point next year. So I think the battle is real inside the room over these next 2 days. It's not as easy to get the consensus as he's had before. But for right now, it does seem like the inflation battle still remains at front and center, but they take a pause here and wait for more data.
Okay, we'll be listening for Fed Chair's comments tomorrow. Cindy Beaulieu, Conning, CIO North America. Good to talk to you today.
Thank you. Nice to talk with you as well.